So right now, if you look at the headlines coming out of Tokyo, the media is basically popping champagne.
Oh, absolutely. It's all celebration.
Right. I mean, Japanese government bond yields have hit a 30-year high, wages are finally rising, and the mainstream consensus is cheering this as this massive domestic success story, marking the end of Japan's multi-decade deflation trap.
Yeah, they really are.
But the thing is, that exact same success story is quietly pushing frontier markets on the other side of the planet to, well, the brink of total economic collapse.
It is, it's really the ultimate paradox of global finance right now. I mean, the crowd is celebrating this homecoming of capital, but they are completely ignoring the structural vacuum that homecoming creates literally everywhere else.
Right. So welcome to this deep dive. Today we're unpacking a really fascinating macroeconomic dispatch titled The Homeward Tide.
It's a great read.
It really is. And our mission today is to look at the hidden wiring of the global economy, and connect some massive dots that the daily news cycle is just entirely misinterpreting.
Because they're missing the big picture.
Exactly. We're going to track how Japanese pension mandates, Middle Eastern banking disputes, and Chinese urban employment data are all colliding to rewrite the rules of global liquidity.
Yeah, it's all connected.
So by the end of this conversation, you'll have an insider's view on how global money actually moves behind the scenes and why those traditional safety nets are snapping.
And to understand the sheer scale of what is happening, you really have to look at the plumbing.
The plumbing, right?
Yeah, and the most critical valve in that plumbing is currently located in Tokyo, where capital is being pulled back by both price and policy.
Well, let's start with that catalyst because the price signal is pretty obvious, right? Japanese government bond yields, those JGBs, have hit their steepest level since 1996.
Which is wild to think about.
It is wild. And the Bank of Japan is signaling further rate lifts, but there is this massive policy signal that dropped in the exact same week, acting as this, accelerant.
Yeah, the finance minister's announcement.
Right. Finance Minister Katayama publicly urged the Government Pension Investment Fund, the GPIF, to invest more of its capital at home.
And look, the scale of that request just cannot be overstated. I mean, the GPIF is the largest pool of retirement savings on the planet.
It's massive.
Right. So when the Japanese finance minister tells a multi-trillion-dollar fund to shift its allocation toward domestic assets, the ripple effects alter the cost of capital globally.
But wait, if we look at this from Tokyo's perspective, shouldn't we want a country investing in its own infrastructure and its own people?
Sure, absolutely.
Getting their fiscal house in order seems like a fundamentally healthy move, So why frame this as a blaring global warning siren?
Well, for Japan's domestic economy, it is absolutely a triumph. The danger lies in how the rest of the world has positioned itself over, the last 20 years.
Okay, how so?
Well, Japan is the world's largest creditor nation. For decades, Japanese institutional savings, so pensions, life insurers, commercial banks, they've acted as the marginal funder of global debt.
Oh, wow. So they've been funding everyone else.
Exactly. The entire architecture of international finance has basically grown dependent on this permanent baseline of cheap Japanese capital exports.
Right, because interest rates in Japan were pinned at zero or even negative for so long, massive global investors utilized the yen carry trade.
Yes, the infamous carry trade.
Right. For those who track this, it's a known strategy. They borrowed in cheap yen to fund higher-yielding, riskier assets in emerging markets.
And that carry trade became the absolute foundation of global liquidity. I mean, the assumption built into nearly every sovereign debt model was that Japan would just perpetually supply this cheap funding in an orderly way.
But now that's changing.
Right. When Katayama demands the GPIF bring capital home just as yields are spiking, that foundation fractures. Capital is being aggressively pulled back to Japan.
Which means?
It means the cheap yen funding that the rest of the world relies on to sustain their debt loads is evaporating literally overnight.
So it's like the neighborhood's most generous lender suddenly deciding to call in all their outstanding loans so they can finally fix their own roof, right?
That is a perfect way to put it, yeah.
And a massive liquidity vacuum opens up on the block. And the first entities to suffocate in that vacuum are the borrowers who rely on rolling over their debt just to, keep the lights on.
Exactly.
Yeah.
Most vulnerable ones.
Right. The dispatch zeroes in on frontier markets, specifically highlighting the situation unfolding in Pakistan, which, honestly, it reads almost like a geopolitical thriller.
It really does. It illustrates perfectly how desperate the search for external financing becomes when the underlying cost of money structurally climbs.
Yeah.
You see, sovereign debt for frontier markets like Pakistan, Egypt, or Ethiopia, it's priced directly against that Japanese funding leg.
So when Japanese rates go up.
Right. As Tokyo's yields rise, the rollover costs for these frontier nations spike exponentially. They can't afford their own debt anymore.
And we are seeing Pakistan engage in this frantic, almost surreal diplomacy just to appease the bond market.
Oh, it's wild.
It is. Islamabad has shifted away from a U.S.-Iran diplomatic track, and now they are actively trying to mediate between two heavily armed rival administrations in Libya.
Yeah, Libya of all places.
I mean, they are essentially trying to broker peace in a fractured North African country thousands of miles away. Why?
They are doing this because they are facing an impending maturity wall and climbing energy import bills.
So they're desperate.
Completely desperate. They desperately need to show the market and the IMF that they have some sort of foreign diplomacy leverage that might magically translate into financial support.
But wait, the market actually seems to be buying the narrative, right? They are pricing in the hope of a diplomatic signature.
Which is crazy if you think about it.
Yeah, because if you were looking at the hard math of a sovereign maturity wall, a communique or a photo op doesn't actually settle an energy bill.
No, it absolutely does not.
Right. A wider diplomatic footprint is not a hard currency disbursement,
Right.
and the timeline doesn't pause for peace talks.
Exactly. You cannot take a diplomatic press release to the central bank to offset your current account deficit.
You really can't.
But the market is pricing in the hope of a signature. And hope is just not a viable economic strategy when the structural cost of rolling over debt is climbing this aggressively.
So Pakistan is basically attempting to pull geopolitical leverage out of thin air.
Yes, because the cheap Japanese liquidity they previously relied on is just gone.
Which brings up a glaring question, I think. Normally, when an emerging market hits a debt crisis of this magnitude, we see bilateral allies step in, right?
Normally, yes.
The traditional safety nets deploy. But the dispatch paints a much darker picture, arguing that multiple global safety nets are fracturing at the exact same time.
And that convergence of failing safety nets is probably the most alarming revelation in this entire analysis. We are literally watching the invisible backstops of the global economy dismantle themselves.
Okay, let's unpack the Middle East component of this first. The dispatch cites a recent Financial Times report detailing how Saudi Arabia is actively blocking or delaying bank transfers to UAE accounts.
Yeah, specifically targeting transfers from the kingdom to businesses in Dubai.
Right. And a lot of mainstream analysts read that and just dismissed it as standard rich state rivalry, just economic friction between two Gulf giants competing for regional dominance.
Which is such a surface-level take. Dismissing it as a regional squabble completely misses the sovereign credit implication.
Very so.
Because Saudi Arabia and the UAE do not just represent regional wealth, they are the invisible backstop for the global frontier.
Okay, break that down for us.
Sure. So when a nation like Egypt or Pakistan approaches the IMF for a bailout package, the IMF rarely covers the entire financing need, right? They model out what they call a gross financing gap.
Right, and they need someone to fill that gap.
It's exactly. For decades, the IMF's mathematical baselines have essentially taken for granted that Gulf central bank deposits, debt rollovers, and direct investments from Riyadh and Abu Dhabi will seamlessly plug those gaps.
Wow. So the multilateral institutions literally built their debt sustainability spreadsheets on the premise of reliable, coordinated Gulf bilateral flows.
They did.
So if Saudi Arabia and the UAE are engaged in this financial proxy war, freezing payments and returning each other's bank transfers,
then the probability of them coordinating a massive multi-billion-dollar bailout deposit drops to near zero.
Yeah, that makes sense. The friction between Riyadh and Abu Dhabi literally breaks the IMF's math.
Exactly.
The invisible backstop is paralyzing itself at the exact moment the frontier markets are being squeezed by that Japanese liquidity drain we talked about.
It's a perfect storm. And while that backstop fails in the Middle East, a completely separate, equally critical safety net is dropping out in Asia.
Oh, right. China.
Yes. The economic floor provided by China is giving way, affecting an entirely different set of vulnerable nations.
Let's get into that, because the dispatch notes a major policy shift from Beijing. China just dropped its urban jobs target for the first time in decades.
First time in a very long time, yeah.
And they are simultaneously pressuring rating agencies to strip AAA ratings from riskier domestic corporate borrowers. On paper, I mean, that just sounds like internal bureaucratic housekeeping.
Right, it sounds boring. But the urban jobs target is much more than a domestic political benchmark. Historically, it has functioned as a proxy guarantee for massive infrastructure and construction stimulus.
Oh, because they have to build things to create the jobs.
Exactly. When Beijing commits to a specific number of urban jobs, it essentially guarantees the creation of the apartment complexes, the highways, and bridges required to actually employ that workforce.
Which requires an astronomical volume of raw materials, like copper, iron ore, hydrocarbons.
Massive amounts, yeah.
So by dropping that jobs target, Beijing is officially conceding a major growth slowdown and signaling that the infrastructure engine is being deliberately throttled down.
And throttling down that engine instantly erodes the import demand floor for Sub-Saharan African commodity exporters.
So countries like Angola, Zambia, and Nigeria.
Right. They rely heavily on selling raw materials to fuel Chinese construction. If China isn't building, they aren't buying.
And once again, I assume the IMF built its debt sustainability models for these African nations on the assumption that Chinese commodity demand would recover to historical baselines by the mid-decade, right?
You guessed it. We have a catastrophic convergence of flawed assumptions right now.
It's unbelievable.
The global financial system assumed Japanese capital exports would remain cheap and orderly. It assumed Gulf rollovers would remain reliable and coordinated. And it assumed Chinese infrastructure demand would perpetually recover.
So it's a triple threat. The cheap money is gone, the bailout cash is politically frozen, and the resource demand is evaporating.
Yes, all three foundational assumptions are crumbling simultaneously.
This completely recontextualizes the current state of emerging markets. With the broad safety nets gone, global capital is forced to become ruthlessly selective, isn't it?
Oh, absolutely ruthless.
It is fascinating to look at how this plays out across Asia, specifically. You know, the divergence between countries that are drowning and those that are miraculously swimming against this homeward tide.
The contrast is just stark, and it hinges entirely on the structural nature of the capital a country is able to attract in a high-rate environment.
Let's talk about the losers first. We see the collateral damage pretty clearly in places like South Korea, where the Kospi index recently slid into a bear market, right? Down over 20% from its June peak.
Yeah, they're definitely feeling the pain.
But Indonesia's situation looks far more precarious. They are dealing with their first trade deficit in 6 years, and they've been forced into currency defense rate hikes.
And it gets worse for them.
Right, because the dispatch flags a much larger structural threat for Indonesia, referring to it as the double trapdoor.
Yeah, that double trapdoor represents a nightmare scenario for any emerging market equity portfolio.
So Indonesia had already received an index downgrade warning from MSCI, but now the dispatch notes they have drawn a second downgrade warning from S&P Dow Jones.
Which is devastating.
Right, for anyone managing institutional money, drawing a second index downgrade is fatal because it triggers massive automatic selling from passive index funds.
Exactly. The algorithms don't care about the fundamentals of an individual Indonesian company. If the country is reclassified, billions of dollars are structurally forced out.
Just indiscriminate liquidity drain.
Yes. When the trapdoor opens, forced passive selling overwhelms any domestic economic policy the country might try to implement. It just accelerates the capital flight initiated by the Japanese yield spike.
Okay, so Korea is in a bear market, Indonesia is standing on the double trapdoor, and capital is fleeing the broader emerging market space. Yet the dispatch remains explicitly constructive on India.
Yeah, they are highly bullish on India's position, despite the whole macro environment.
Why is India the outlier?
Because they are capturing a fundamentally different classification of capital. They are absorbing strategic inflows, which operate on completely different incentives than the fickle carry trade money that is currently fleeing the frontier.
Okay, the dispatch actually highlights two massive developments on this front. Amazon just positioned itself as the largest foreign inviter in India's AI sector.
Which is huge.
It is. And furthermore, we just witnessed a first-of-its-kind India-Japan Defense Co-Development Pact, which presents an incredible paradox to me.
Right.
We just outlined how Japanese pension capital is fleeing emerging markets broadly to chase domestic yields, yet Japanese defense capital is actively flowing into India.
It perfectly illustrates the bifurcation of global money. I mean, fickle carry trade capital, the hot money looking to exploit a quick yield differential, it has zero loyalty.
Right, it just chases the numbers.
Exactly. It exits at the first sign of spread compression or index downgrades.
But strategic geopolitical capital is sticky.
Yes, very sticky.
When a nation invests in defense infrastructure co-development, or establishes a foundational AI footprint, that money isn't chasing a quarterly yield. It is embedded in national security and long-term technological supremacy.
And India is swimming against the tide because it has positioned itself as a geopolitical necessity, capturing that sticky money that doesn't flee when bond yields fluctuate.
So India has effectively built a moat against the shifting financial currents.
They really have.
However, the dispatch astutely points out that India's binding risk isn't derived from global finance at all. Their primary vulnerability is entirely domestic and physical.
Which is so interesting. It's the monsoon.
A literal weather pattern dictates their near-term economic stability.
Exactly. Because if the monsoon fails, widespread crop failures immediately trigger acute food inflation.
And agricultural inflation forces the Reserve Bank of India into a severe rate hold dilemma.
Right. The central bank becomes completely paralyzed. They cannot lower interest rates to stimulate broader economic growth because they're forced to combat the inflation at the grocery store.
It is a brilliant reminder that a nation can outmaneuver global financial algorithms, and secure sticky geopolitical capital, yet still find its monetary policy held hostage by the physical realities of the climate.
It really grounds the whole conversation.
It does. We have mapped out an incredibly complex global architecture today. From the underlying plumbing of the Japanese yen carry trade unwinding, to Pakistan's desperate geopolitical maneuvering, the fracturing of the Gulf's invisible backstops, the erosion of China's infrastructure floor, and the strategic moats being built in India.
It's a lot of ground to cover.
It is. So as we synthesize all of this source material, what is the definitive takeaway you want the listener to apply to their own understanding of the markets?
Well, the author of the dispatch frames it flawlessly with their closing metaphor. The water was already leaving. Tide does not announce itself at the turn.
Right. If you glance at the surface right now, the harbor looks perfectly calm. Developed market economic data reads relatively benign, and equity markets are, like we said, celebrating the Japanese transition.
But that surface calm provides a profound false sense of security. The vital principle to internalize from this analysis is that funding leaves before price does.
Funding leaves before price does.
Exactly. You cannot trust the surface-level price action of sovereign bonds or emerging market equities to tell you the true story. You have to track the direction of the underlying capital.
So, the frontier debt spreads might still, quote, high water today, but the primary funder of the global system has already turned for home.
Yes. The underlying liquidity has shifted, and the safety nets have been dismantled. The ebb has already begun, even if the broader market hasn't really priced in the shoreline yet.
The water is leaving while the harbor still looks full. It is a sobering but incredibly clarifying framework for analyzing global risk.
It really is the best way to view it.
Well, thank you for joining us on this deep dive. You are now equipped to see the structural currents that the mainstream headlines are entirely missing. Before we sign off, I want to leave you with one final lingering thought to mull over. We have spent this time analyzing how this homeward tide impacts sovereign debt, passive equity flows, and central bank reserves.
The macro stuff?
Right. But if the world's largest creditor continues to hoard its cash at home and the traditional safety nets from the Middle East to China permanently fracture, how long until this new era of every country for itself trickles down to the physical economy?
That's the real question.
How will this massive reorganization of capital reshape the everyday products, the pricing structures, and the physical supply chains that we all rely on? When the financial tide finally goes out for good, what does the new map of the world actually look like?
It is the defining economic question for the decade ahead, honestly. And the answer will not be found in yesterday's financial models.
It certainly won't. Keep questioning the surface narrative, keep looking for the underlying plumbing, and we will catch you on the next deep dive.